Alright, so this Halloween has investors terrified, but for all the wrong reasons. Just saw this article recently on Barron's, but apparently we're having the most expensive Halloween on record because so far Americans have spent $10.6 billion on things like costumes, decorations, candy, and cards. And that means that this is one sweet surprise. Please smash the like button and you too can save a Kinder Egg. Now if that doesn't scare you though, here's what might. It's what's happening to the stock market, specifically tech stocks, because this right here is Amazon's stock chart. And October 27th, it lost 20% in after hours trading. That represents roughly 2 to 3 years worth of gains wiped out in a single day. And they said Bitcoin was volatile. So the main reason we have to address what's happening with tech stocks right now is because tech represents roughly 25% of the S&P 500's or the stock market's value. In fact, Microsoft, Google, Apple, and Amazon, just those four represent about 20% of the S&P 500's value or market cap. And last week, we just got earnings reports from those companies, and I don't think I've seen losses that big from major tech companies in my entire lifetime. Meta, for example, lost $700 billion, and their stock price right now is at the lowest point since the beginning of 2016. And their market cap, which is at $266 billion, is roughly $50 billion less than Home Depot. I just saw this tweet recently, it's pretty crazy. In fact, Meta stock price got so bad that even Jim Cramer went on CNBC, he got super emotional, and he had to apologize for his belief in the company and getting it wrong. But it's not just Meta, it's also Microsoft and Amazon because they lost a ton of value too. But what's crazy is that their earnings weren't even that bad. What was bad was what was in their guidance, which is what they tell investors they think will happen in the near future, which implies the recession would get worse. So in today's video, I want to make sense of what tech stocks have told us about the near future, why tech stocks are collapsing, and what this means for the recession. So if that sounds interesting, let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the magic. So Twitter is now a private company. It's official. So let's congratulate Elon Musk and his team, Chief Twit, Chief of Memes, Chief of Operations, Chief of Marketing, Chief of Design, Chief of Technology, Chief of Product, and of course, Chief of Finance. First, let me explain exactly what all of these tech stocks have been telling us, starting with everyone's favorite, Meta. There's a lot to say about Meta. Back in my day, it used to be called Facebook. Before Facebook, there was MySpace. And back in my day, it used to be called the Yellow Pages. I'm sorry. I had to. So Meta's share price went down to around $100 a share, which is the lowest level since around 2016. And there's a couple reasons for that, but the biggest reason is because their income has been going down and their expenses have been going up. Their overall net income, for example, is down 52% in Q3 of this year, and their expenses are up 19%. But what's crazier is how much money they told us they're gonna spend just to operate their business this year, which is anywhere between $85 to $87 billion. But reason number two is what they told us they'll spend next year. That's estimated to go up between $96 to $101 billion in 2023. And the reason that this is huge is because last year was Meta's most profitable year when they made $117 billion. But they're telling us that next year they're gonna make less money and they're gonna spend more money. Investors don't like that, so they sell the stock. Another major reason the stock is selling off and going down is because investors are losing confidence in the idea of the metaverse. This was the whole reason why Facebook changed their name from Facebook to Meta. But since doing that, they've already lost over $500 billion in market cap. And they were supposed to be the company that brings us Ready Player One, where we could put on a headset and be transported to a new world and have new experiences. But so far, they've lost $9 billion in the first 3 quarters of this year. And they already told us that next year, they're gonna lose even more money. Could you imagine spending $9 billion and all you get was this? I can definitely imagine because I bought NFTs and it was supposed to be an experiment. I just never said it was going to be a successful one. To add to that though, there's also pressure from TikTok and people are spending less time on Facebook and advertisers are paying less money for ads. If you combine all of those reasons is why Meta's price is going down like crazy. But that's Meta. There's arguably even bigger and more important tech companies to the economy, and they are Microsoft and Amazon. So here's why their share prices have collapsed and what they're telling us about the economy. But first, a quick word from today's sponsor. Alright, so I'm really excited to tell you about MooMoo's new features. Now, MooMoo is a free stock trading app and it's owned by Futu, which is a NASDAQ-listed company that's been around for 10 years. Now, there's 3 specific features that I really like and that make investing really easy and intuitive. Number 1 is their earnings calendar, and you can access this feature by tapping on the Markets button and then clicking on Today to see all of the companies that are reporting their earnings for that day. And if you want to see all of them, just click on Show All. But the best part is that you can tune in and watch those video conferences live by tapping the Live button or rewatch them later by tapping on the video icon. And number 2, MooMoo provides a visual way to look at financial information so you can better understand and evaluate individual stocks. And all you have to do to access this feature is tap on your favorite stock, and at the top tap Financials, and there you'll see the 4 sections called Revenue, Indicators, Estimates, and Statements. And number 3 is Institutional Tracking. Now, this is a really cool feature that lets you see exactly which stocks institutions are investing into. Like, for example, when Warren Buffett invested into ticker symbol OXY. And the way to get to this feature is to tap on the Markets section at the bottom of the app and then tapping on Institutional Tracking to see exactly where their money is being invested. Super cool. But that's not the best part. The best part is that MooMoo's given away 15 free stocks, each valued up to $2,000. It's incredible. So here's how you can get them. If you open an account, you'll get 1 free stock. Then if you fund your account $100, you'll get an additional 4 free stocks. Then if you fund your account $2,000, you'll get another 10 free stocks. Now, if you do this, please make sure to maintain your average account asset balance by $100 or $2,000 to keep the stocks after you unlock them. And if all that wasn't enough, to celebrate MooMoo's 10-year anniversary, you can get $10 cash back when you open a new account and complete your first deposit on top of the new user reward. And this applies to both US and Australian users, but only if you sign up using my link down below right here. So go check it out, don't miss out on the deal, and now let's get back to it. All right, so let's talk about Microsoft and Amazon because they're a huge part of the economy. Unlike Meta, Microsoft actually beat their expectations. Their overall revenue grew 11%. So they actually made more money than investors thought, but their stock price went down almost 8% last week when they announced it. How is that possible, right? That was one of the biggest questions I had when I first started investing. If a company makes more money, shouldn't its stock price also go up? And the answer is not exactly. Always remember that the stock market is forward-looking, and the money that Microsoft has already made was in the past. What matters more is what they've told us about the future. And their guidance has told us that at the end of the year, their costs are gonna go way up and their income is gonna go down. And that's why the stock is going down. And the main reason for that, by the way, is super green. Right now, you can see that the dollar is extremely strong in the DXY index, which has a huge effect on a company like Microsoft, which makes roughly half of its revenue from doing business overseas. That's because when they sell their products internationally and they get paid in those weaker currencies, when they convert those currencies back to the dollar, they get less dollars. And this will continue happening because the Federal Reserve keeps raising what's called the federal fund rate, which makes bond rates go up. And that attracts even more money to come into the dollar, which makes the dollar stronger. So this will keep affecting companies that are doing business overseas. So that's Microsoft. But the same lesson can be learned with Amazon. Now, this is the exact reason why I don't try to focus on individual growth stocks, because sometimes the market just makes no sense. Check this out. Amazon stock fell 20% in after-hours trading, which means they lost 2 to 3 years worth of progress in a single day. Now, for Amazon to lose $200 billion worth of value, something catastrophic has to happen. But instead, all that happened was they missed their income expectation by a fraction. Their expected income was supposed to be $127.6 billion, but they made $127.1 billion. That is a miss of 0.5%. That does not make sense that a company could miss by half and lose 20% off its value. But sometimes that's how the stock market works, and it makes no sense. Now, obviously, I'm simplifying a little. It's more than that. It's also the guidance of what they're telling us about their future income, but they're telling us the same thing everyone else is. Their expenses are going up, their income is going down, and their customers are spending less money. But fundamentally, nothing has changed for Amazon. So that's all really interesting. So that's all tech stuff. Now let me tie it all together and explain exactly how this affects the economy and the recession. More layoffs are coming. As many as 12,000 at Meta, thousands at Intel, 1,000 at Microsoft, and Elon Musk plans to cut 75% of Twitter's workforce. Now, speaking of Twitter though, have you heard of this crazy concept called the golden parachute? It's a severance package which you are given so much money that your feet could never theoretically touch the ground, which is kind of interesting because a golden parachute would technically sink to the ground, so it should have been a helium parachute, but you get the idea. The CEO of Twitter was actually let go and was given $38 million, and the CFO was given $25.4 million. Now, I know that their executive team probably more than deserved their payout because they were instrumental in making Twitter successful, but it's just such a crazy idea to me. Like, could you imagine being fired or let go and then given $38 million? Tell you what, I'll fire myself right now and give myself 50% of that, and I won't even tweet about it. Jokes aside though, what the tech companies say about the recession is that they're making less money, and the money that they are making overseas is worth less thanks to the stronger dollar. And because they're importing less dollars, they have less money to pay people here at home thanks to higher inflation, and thanks to the fact that most of their clients, which are using their platforms to advertise on, which is how most of them make their money, because there's less demand, they also are making less money here at home. Now, this will have a spillover effect eventually into other sectors and other industries because tech is usually the one to lead the market. They're the first to analyze all of this valuable data and the rest of the market follows. So that's what I believe will happen, and that's why I've said in the beginning of this year that what I would do is I would focus on making myself as valuable as possible for the company that I work with so that I don't lose my job, because the name of the game in a recession is to not lose your job, and I think that will continue to stay true even more so next year. Now, if you made it this far into the video though, let me give you my personal thoughts. This is very anecdotal evidence, and I'm not saying that my small YouTube channel represents the broader economy, but personally, this year my YouTube channel has gotten way more views than it did last year, but my ad revenue was cut by 50%. Now, I'm not complaining, I'm just saying that I've personally noticed that advertisers are spending less money on these tech companies. And this is true not only for my channel, but also for my friends' YouTube channels as well. And I've noticed that what happens behind the scenes in Google Analytics eventually catches up to the broader economy, and it kind of makes sense that tech companies get their information first and then everyone else follows. Also though, full disclosure, I don't really invest into individual tech stocks and growth companies. Instead, I stick with the boring stuff because that's what makes sense to me. And right now, those stocks are doing really, really well, especially the oil and the energy stocks. I've just stuck with that since I've started investing, and I look like I'm a genius right now, but I'm not. It's just something that I've stuck with. And it's interesting because investing has its moments. I remember when the pandemic was happening, everyone was buying tech stuff and that was exploding, and my dividend growth portfolio was just down, and it didn't look very good, so I didn't look smart. So some years we look good, some years we look bad, because investing is cyclical. It ebbs and flows, which is why I try not to be critical of other people's strategies, because what matters most is how long you're invested for. But I will say this though, even though tech stocks have done really well, investing doesn't go up in a straight line. It's why the top 7 tech stocks have lost $3 trillion worth of value in the last year, why Meta just lost 6 years worth of investing progress, and QQQ, which is the 4th most popular ETF stock in the world, is down 30% this year in comparison to the stock market's 20%. Investing doesn't go up in a straight line, but that's okay. It's all cyclical, and eventually it comes back up given enough time. So continue investing, keep going, and there's no right or wrong answer, and I'd love to know your thoughts. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab up to $250 worth of free Bitcoin right here. Don't forget to move it offline, grab your free stocks. Links are all down below. Go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes Wednesday. I'll see you soon. Bye-bye.